But silver sat there and sat there. Gold broke out almost 2 years ago, made new all-time highs, and has now doubled in price, where silver just only made new all-time highs back in October.
Yeah.
So it's moving to catch up. The force that applied, it just sits there and doesn't go anywhere. Then all of a sudden it starts to move up and volume picks up, and these CTA trading funds, other traders and the like start to jump on, and it creates its own momentum. That took it up to 48, that the old all-time highs, that blasted it through to 54. It then pulled back, held 48 as support. Now it's blasted through again. Ultimately, I think, Kerry, it does a gold. Or gold took about 18 months for it to double in price after it made new all-time highs in March of 24. Figure silver, it's not going to take 18 months, but it's following that same path.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Man, I am floating on air. Silver, 60 years of suppression. Craig Hemke is with us. Craig, 60 years. Because I wrote an article recently about the demonetization of silver in 1965, what LBJ did. The fact that the funniest thing about it, Craig, was that they created the Kennedy $50. And at the same time, they pulled silver out of the coinage. However, they couldn't pull it all out of the Kennedy $50 because then it would have cheapened Kennedy's image in the eyes of the public. So what they did was they made it 40% silver, the minimum amount they could use, so it didn't look like a Johnson slug, as our good friend David Morgan calls them. And, that lasted for like 4 years. But so the first ones, the 64s came out, they were 90%. They got hoarded up instantaneously as keepsakes. They cut the silver to 40% and 65 to 69, and they still couldn't keep them around. I've been buying those personally because they're considered the junkiest of the junk silver. Up until a couple weeks ago, they were selling at discounts to melt value. Anyway, I'm digressing, but it's been too long. I think the last time I talked to you, silver was around $35 the ounce, where now it hit close to 62 on the Crimex today. Nothing you're surprised about, is it?
Yeah, I would imagine. Anyway, good to see you, Kerry. Yeah, when we probably spoke back in September, I think was the last time. And back then we were all waiting. It was like, well, gold had been going sideways, into through all the month of August for 4 months. Silver had been going sideways, particularly to silver. I'm sure I probably mentioned and described it as Newton's law of inertia. I think they also call it the first law of motion. An object at rest kind of remains at rest until a force is applied to it. And that force has been applied and continues to be applied now to silver. And it's kind of it's a FOMO, it's a momentum thing. It's a virtuous cycle. It's why is it going up? It's because it's going up. Now, there are a lot of other things in play. The global supply picture, how much metal is there truly in the vaults in London and what's going on in Shanghai and all that stuff. But silver sat there. Gold broke out almost 2 years ago, made new all-time highs, and has now doubled in price, where silver just only made new all-time highs back in October.
Yeah.
So it's moving to catch up. The force that applied, it just sits there and doesn't go anywhere. Then all of a sudden it starts to move up and volume picks up, and these CTA trading funds, other traders and the like start to jump on, and it creates its own momentum. That took it up to 48, that the old all-time highs, that blasted it through to 54. It then pulled back, held 48 as support. Now it's blasted through again. Ultimately, I think, Kerry, it does a gold. Or gold took about 18 months for it to double in price after it made new all-time highs in March of 24. Figure silver, it's not going to take 18 months, but it's following that same path.
Hey, so we're going to create Hemke's first law of metals markets. That is,
I like it.
okay, if a metal is suppressed, it stays suppressed until an external force forces the suppression to end.
That's right.
Gold pool in the 60s,
Yeah.
obviously gold all throughout, our adult lives basically has been suppressed, and silver is the perfect example. I
Yes.
knew at 32.5, and I think we had even talked about that number because I seem to remember I'm going to look it up. We had an interview way back when, and that 32, 33 number was kind of like really an important number. And once it blew through that, I think in May, that was it. And we got three things happening here. Two of them I'll mention. Another one, you can send me an email. But look what happened Thanksgiving. The day after Thanksgiving, melt up, right?
Mhm.
We went up $2-3. I can't remember.
350.
350, right? And
Yeah.
why was that? Because I have a theory, and most metal traders never take off the holidays. They'll take off any other times, but they won't take off the day after Christmas, the day after Thanksgiving, and the day after New Year's, because all of the banks have got their A teams are off skiing in Zermatt. The B teams in Florida or in the Caribbean. The C team is showing up, but they're hungover, and the D team is the margin clerks. The margin clerks are running the show, and that's why you have these blowouts. So we got one
Yeah.
coming up here, Christmas, right? December 26th, and then we got January 2nd. In addition, that's when all the funds realign their portfolios. Now,
Hmm.
like, I don't want to make predictions because, I'm always wrong, but certainly the groundwork is set for a monster move forward. Plus, we're in the
Yeah.
seasonality, fourth
Right.
quarter, beginning of the first quarter. I
Yep.
mean, what's the limit here, Craig?
You hit them all, Kerry. Let's touch on your first point about the breakout on Black Friday. There's a lot of what's actually I hate to call it nonsense, but it's verifiable. It's just clickbait that made it sound like, oh, there was some massive amount of deliveries at the COMEX that caused the market to melt down. That's bogus.
Oh, yeah.
Anybody that tracks the metals knows where to find this information, the CME's own website. And all that was the typical first night of deliveries on a delivery month. And it wasn't one big order for 7,000 contracts. That's all bogus. What happened on Friday, Black Friday, right? Light volume, like you said, A, B, C team, everybody else is not there. And two things happened. That high from October 16th was about $54. Price went down to 48, then it went back up to $54. And then immediately there's this chorus of people that wanted to be the first to say it was a double top, which is not. But so everybody starts looking at it that way. And so if you're a trader and you're short, where are you going to place your buy stop, Kerry? Right above 54, right?
Yeah, heck yeah.
If it breaks out, I'm going to have a stop order in it. And when you're short, it's a buy stop. And you're just going to have that on there good till canceled. At the same time, we move through 54 during COMEX hours on Black Friday. So it's light volume, not many people around. And you get this surge of buying from these CTA, managed commodity funds, commodity advisors, chasing the volume up through 54. At the same time, you get all this short covering, which is more buying, and you end up with a $3.50 up move up to 57.5 or whatever it was on that Friday. Kerry, actually, the same thing happened. I was recording this here on Wednesday, the 10th. The same thing happened yesterday, Tuesday, the 9th.
Yes.
Reasonably light volume day while the FOMC was meeting. We moved up through those 57 highs, and it happened again. And you can actually see on the volume chart, you get little 5-minute candlesticks. The highest volume of the day was right when price broke through 57, and you got another surge of the CTA buying and short covering. Yeah, so it becomes again, this inertia thing. It becomes higher prices lead to higher prices type of thing. Now, we've seen, the CTAs can rush for the exits all at the same time too. We saw some of that in late October, so you got to be mindful of that. But there's a lot of stuff going for us, and we can kind of talk through the stuff, one by one if you want. But there's a lot suggesting that we're going to rally into year end and rally in January as well.
Yeah, well, it's a coil. I think I once talked about it, the jack in the box. You keep turning the handle, and eventually that thing pops out. And, it's just, it always feels good to be right for a change. As we watched this for, really since 2011 with a couple of breakouts like COVID and 16, but, it never got over 30 for long. And, to all of a sudden see it finally. And really, like, the amazing thing was, like, I'm buying stuff on eBay and, like, you can it's not front running, but, like, people would put up their silver on, like, Thursday, and Friday there'd be a run up, and then they didn't take it down. They didn't change their price. So you're buying it below melt value on eBay.
Yeah.
All right. Now, obviously, if price goes down, you're above melt value, but that hasn't happened. And you could just pick them off. And then there's mispricing. There's a lot of like unsophisticated sellers. And then there's sophisticated sellers like coin shops that should know better, and they're messing up. Now, all of those discounts to melt are pretty much gone. Maybe you can find some war nickels.
Remember, people were saying all the time back in 2015 and 17, silver will never go up because as soon as it gets to 30 and 40, everybody's going to be selling all the silver they bought in 2010, and people are going to be dumping grandma's candlesticks and all that kind of stuff. Well, hell, we're all the way, we blew through that, right?
Yeah.
It's you mentioned though, Kerry, we've been talking about, you and I met in what, like 2012.
Right.
This is all stuff we've discussed now for over a decade. The physical supply issue, the leveraged markets, the derivative markets that were created in 1975 to kind of alchemize metal, to get people to accept a dot on a screen, a futures price is the actual price. Right. And then these banks that live, hand to mouth, between managing the price in New York and delivering the metal in London, kind of just in time delivery, managing their books, using the ETFs as flywheels. Anytime they really get short metal, they get some out of the SLV or the GLD, and they short it and they get it out, and then they hope they can buy it back later and put it back. All of that crap has been going on for as long as you and I have been talking. Well, and we knew it was, this is a certainty that this was eventually, the music was going to stop.
Matt, it's math. It's pure math.
Exactly. And that's where these banks are now. Whether it's the central bank demand and now the tether demand that underpins the physical market for gold, or whether it's the 800 million ounce supply deficit over the last 4 years, combined with ramped up industrial demand for silver, all of these things are now kind of coming home that can't be shell gamed away anymore. And that's where, I see this stuff every day, these wave counters and people, the technical analysts and the stuff, and they try to, create a reason why that dot on the screen is going to go back down to like its old moving average or something. It doesn't have anything to do with any of that at this point. And that's where the people listening to you and I hope they've been listening all these years, but I hope they're not looking at the price and going, oh gosh, it's too expensive. The one last point while I'm on this thought, Kerry, that people need to understand, if you're looking at gold specifically, or silver for that matter, and saying it's expensive and it's got to go down, you're looking at the price all wrong. Gold hasn't changed. That's why the gold doesn't have any utility, right? It just collects dust. It's a pet rock. It doesn't pay a dividend. All this. Gold is just gold. And what's changing is the amount of dollars or euros or yen or whatever that it takes to buy that same ounce. The gold hasn't changed. What's changing is the destruction of the purchasing power of your currency. For the dollar 10 years ago, it took $1,100 to buy That's 1 ounce of gold. That same ounce of gold 5 years ago took $2,200. That same ounce of gold takes $4,400. It's not the gold that's getting expensive. It is your currency that is wasting away, and that's how people need to understand it.
Well, that is true, but we have with silver, we got an added boost there.
Well, and that too. I mean, it's the same thing. Yeah.
Shortage. We have shortage. We have escalating, burgeoning industrial demand, and manipulation that's coming to an end. All right, looks to me like a suppression scheme is all, but we could talk.
Why would you short it? Right? Why would you be shorting it? I mean, saying that if you went at $50 silver, if you were, pick a bullion bank, and we're going to aggressively shorten capital. When you're just getting buried.
Yeah. Rick said when I interviewed him last time, I said, what do you think of the people who are short silver? And he said, the people who are exercising these complex, paper short hedges, whatever, complex trades are going to be annihilated. And you've heard him say it before, they're going to have a religious experience.
That's right. That's what he'd always say. Well, and remember, Kerry, we always, as we would talk about the COMEX and all of this leverage, and it would always come up about the gold-silver ratio. Remember that? And people would always say, the ratio should be 15-1. Instead, it's 100-1. Why is that? And I said, it's actually, I think the best way to understand it is it's a leverage ratio. You might just consider silver is 6 times more levered than gold. Now that's, not, I don't think you can do a 1-to-1 look at it that way. But the reason why it was always 8-to-1 or 12-to-1 to 15-to-1, and all of a sudden it's 100-to-1, is a function of all of the derivatives, the phony baloney, plastic banana, good time rock and roll futures contracts. And that's what's now being forced to be unwound.
Yeah.
And that's where the excitement lies.
Hey, what's our gold to silver ratio now? 68 or 9-to-1?
Yeah.
It was 108?
Yeah.
Right?
Uh-huh.
I mean, that in itself should tell everybody and think, oh, but silver's too high. It's at record pricing. And I'm not saying buy or don't buy. I'm just saying that's not really, and you said it, that's not really a valid reason not to buy because, people are always buying stuff at the top. But the question is, so strategy here, when do you start shedding a little bit of your supply? Are you preparing for Armageddon here? Is this the Armageddon trade?
This is the same answer from 10 years ago, when people would always say, okay, so when do you sell? Well, the problem is if I sell a 10-ounce bar of silver, someone is going to give me back $600 US.
Yeah.
What the hell do I want those for?
Yeah.
That's the problem. I mean, I suppose you could lever it into buying some mining shares or something, or maybe, that's what's great about the legal tender laws that are making their way around the U.S. now.
Mm-hmm.
So you can actually use the metal in exchange for other real assets. Maybe you can buy some land or a home, or, something. But that's the problem. Yeah. Okay. It might sound good. I'm going to sell this now and haul some down to my coin dealer or, whatever. But again, what are you getting when you sell? You're getting dollars back or euros back. And that's no bargain. So you got to have a plan for that. But Kerry, at the end of the day, this has been such a wild year. When I wrote remember my macrocast we talk about every...
Yeah, sure.
We were coming off a 25% year in gold last year. And in the previous 4 times that's happened this century, gold has either gone barely higher, flat, or down the next year. When Kerry, we're up 60% now as a follow-up. So I mean, this is very much unprecedented. And I think in large part it's because it's just a collection of stuff that you're kind of being warned is coming. And it's being front run in a way. And so when people say, should I still be buying or should I still be holding? 2026 is going to be, that's what's being front run now. Remember back in February. Remember Besant with his, we're going to monetize the asset side of the balance sheet. Remember all that talk?
Yeah.
Right. There was also the verbiage of the Buy Bitcoin Act or the Bitcoin Reserve Act, where it says in the bill that they're going to revalue gold to its market price up from $40, $42.22 or whatever it's carried at now, as a deficit neutral way of getting cash from the Fed to fund the Bitcoin Act. So there's all of that's out there. You've got Besant has talked about merging the operations of Fed and Treasury, working hand in glove in 2026. Powell comes out and says all this stuff again today about, oh, well, only one cut next year and all this kind of jazz. And he's as lame duck as it gets. Who cares what Powell thinks? He's gone in May anyway. And so all of this stuff is pointing toward dramatically lower interest rates, probably some form of yield curve control, sharply negative real interest rates, remonetization, revaluation of gold. All of these things are coming next year. So it's not straight up. It's going to continue in this pattern that's held for almost 2 years now of 20% rallies and then consolidations and then 20% rallies. But we're far from a top for gold and definitely far from a top for silver. And so people need to plan accordingly with that in mind.
But we're still seeing higher highs and higher lows. We're saying the trend's your friend here.
Yeah.
And you see it even on a daily basis, the higher highs and the higher lows.
And the dips get bought. There'll be this big mass rush of selling of futures, usually while the COMEX is open, and get these huge red bars of volume, and price will plunge $1 or $1.50 or something. And then that dries up and the volume goes away and price just does this.
Sawtooth. Yeah.
Great fun.
And like we were talking about the day after Thanksgiving, Black Friday. Well, historically, those would be the days when they slammed silver because there was no liquidity.
More often than not. Yeah.
Right. And a very short, just a little concentrated sell into that market, especially in the access market. We even talk about the access market,
right.
Which is most subject to manipulation
for sure.
And even there, when you see silver go up $1 in the access market.
Yeah. You still see them try to hit it. I always call it the after hours, the dillbacks. The bid size, the trading volume shrink by about 90% once the COMEX hours stop. And so you get so much more bang for your buck if you're trying to influence price. And again, I'm not saying it's going to be green candles every day. There's still going to be slams. There's still going to be, the chasing out of that momentum like we saw in October. There's still going to be consolidation phases. Gold is still technically in a consolidation phase. It peaked in middle of October and now we're in the middle of December and we're still below that peak. But there's no reason to suggest yet that any kind of top is in either. You mentioned the pattern of higher highs and higher lows. You start breaking down and making lower lows. Okay, well then we've got something to talk about. But for now, as we head into the end of the year, you said seasonally strong period. Once we get past about the 15th of December and certainly all through January, the dollar is weaker. The dollar's falling again from 100 and is back under 99 when nobody's expecting at this point is the dollar to go back to the low end of its range this year, down near 96. Well, if that happens, that's going to get the computers buying the futures too. There's a lot of really positive stuff for the metals. And my strategy continues to be try to trade the dip and try to ride the next wave up.
I've done something and I don't recommend it. Obviously, we don't give financial advice here.
I can only imagine what you're going to say.
I've done something so stupid, Craig, like the dumbest trade on the street. You know what it is.
I can think of a few, but I can't imagine.
Isn't the dumbest trade, but that's how good this market is. AGQ.
Oh, yeah. Yeah. The all futures ETF. Yeah.
Yeah. The dumbest trade on the street, right? It's just generally, it's
going to zero. Yeah.
Yeah. Because
you can't hold it long. Let's put it that way. You can't just buy it and take a certificate.
But you buy it, it goes up 20% in 3 days.
Yeah.
And then, but, it's not a bad thing to hold when we get these holiday trades coming in.
Right.
We're
Right.
going to see melt ups here
Right.
almost certainly, unless they unload everything and they do the what did we call it? The monetary cannon.
Bazooka.
The contracts. They just dump them. But the danger is, and you've said this for years, and I've quoted you so many times, I always give you attribution, is like when they get to the point where they drive the price below what its physical should be. And then all the buyers come rushing in because
Yeah.
they tripped all the algorithms
Yeah.
and they know that now. And
Yeah.
they just can't do what they used to do, Craig. And
Yeah.
maybe that's where the suppression's really ending.
Yeah. Particularly in gold, and we're probably starting to see that in silver. The gold move, when I wrote the macrocast this year, I said, well, what did I get? I always do that just for myself so I can go back and realize remember what I was thinking in January and what did I get wrong. And what I missed last year was the impact of this relentless, really, central bank demand. We got to throw the tether demand on there too. And so it really hampers what has always been the ability of these banks to just overwhelm the bid and smash price down and get the price rolling, because you get to a certain point where here comes that physical bid and it just pushes it right back up again. And that's been the underlying this pattern really since late 2023, about October of 2023. So it's been more than 2 years now. And we're getting to that point where silver's looking like that too. And that's going to be, again, we don't know. We've always wondered, you remember the GATA hearings on Capitol Hill in 2010, about are there 100 digital ounces for every one physical ounce? No one's ever known. We're in the process of finding out.
Yeah, well, I think
Early in the process, too. Early in the process.
I think Rick knows. I think Eric Sprott knows. I mean, those are the people who really got access to the data, but nobody totally knows, right?
Right. Nobody knows. Exactly. Well, yeah, because it's deliberately opaque, and you don't know, that we could go on and on about the vaults of London and how much silver and gold do they really have underpinning, what are multiples, 10 times, 20 times, 100 times, whatever, the unallocated trade that they have every single day in London. And versus off of this actual physical flow, what is there? And that's what's being drawn down. We don't know how much it is. The London will claim it's a certain number, but nobody knows. Right.
Nobody knows.
And so anyway, it's coming. I remember recording a video for Kinesis 4 or 5 years ago that they turned into a little promo video where I was talking about unallocated accounts and how if you're in one of these deals, at a Canadian bank or, in Switzerland or something,
Australia.
And they say, yeah, this is a great deal. Yeah, it's your metal, but no storage costs. Well, right there, that should shoot up a red flag. Wait a second. An allocated account is my metal, and it says there's 1% storage fee. An unallocated account is supposedly my metal, and it's 1/10 of 1% of a storage fee. Well, then wait a second. That's you right there. Should set off a alarm bell. Anyway, that's where the real weakness is. Those unallocated accounts around the world, where everybody thinks they've got the metal. It's like these hedge funds and the like, even really smart people like Paul Tudor Jones or Stanley Druckenmiller that think they own metal. They've got price exposure when they own an ETF. They don't own jack. And that's where the real weakness is going to show up first. That's where it looks like it's coming. That's what's going to happen.
That's further why ETFs are so risky. Right. Warren Buffett says you don't know who's wearing a bathing suit until the tide goes out and who's swimming naked. And we're going to find out soon enough. Hey, so tfmetalreports.com and go there. It's still less than, it's less than 3 lattes at a certain undisclosed coffee shop. Less than 3. So that is a steal. Especially if you pegged it to silver, could you imagine what your price would be?
That's true. You know what? That's what I should do. I should charge every month what an ounce costs. It's like, it's funny. I like to do contests on my site every once in a while, get people involved on, where's price going to end at the end of the week and all that kind of stuff. The prize typically is, I used to make my own Scottsdale Silver, used to make my own TFMR silver rounds. And so that used to be no problem giving one of those babies away for $20. Well, now it's 60.
Yeah.
No
Well,
more contests.
the dollars are worth less, but we'll do a TFR subscription to physical ratio.
There, I like
Right now,
I like it. It's 1/3.
it's a steal. It's a third. You can't beat that.
I'm stealing that, Kerry. I like that a lot.
And if you'd only listened to Craig 10 years ago, man, you would have paid for a lifetime of TF Metals report. So,
Right.
okay, the link's in the show notes. Questions, comments, shoot me an email, kl@kerrylutz.com. Craig, we will talk to you again real soon. Thanks for coming on.
Always fun, my friend.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.